Welcome to the June 2017 edition of the Zacks Ultimate Strategy Session. Just one of your benefits as a Zacks Ultimate member. This month, we'll see if Tracey Ryniec and Eric Dutram can agree to disagree on the recent Moody's credit downgrade of China. Steve Reitmeister once again answers more of your questions from Righty's mailbag. We'll have a portfolio makeover with Sheraz Milan and Kevin Matras, top stock picks, and more. But first, Sheraz and Kevin give you their fundamental and technical views on the market.
Hi, this is Sheraz Milan. I'm here to share my fundamental view of the market with you. Starting with the big picture, the outlook for the U.S. economy is neutral to positive. It's not great, but it's not bad either. We had a subpar GDP growth trend in the first quarter, which has been a persistent theme over the last many years. But Q2 is off to a good enough start, and the expectation is that growth in Q2 would come in north of 3%, which is good enough. The jobs reading that we got on Friday was subpar on balance, but many in the market think that the weak headline jobs reading will not be enough to hold back Fed from announcing the next rate hike at this month's meeting. Beyond the U.S., the outlook for the global economy is looking good. In fact, for the first time in 5-6 years, all major regions of the global economy are expected to be on a growth trajectory, and we are seeing that in the overall earnings picture too. We had a very strong earnings cycle in the Q1 reporting season, with growth coming in at the highest level in 5 years, and estimates for the current period for 2017 Q2 not falling as much as has been the trend in recent years. So overall, the macro outlook, both in terms of the economy and earnings, appears favorable for stocks. And we see that in the major indexes too, particularly in the S&P 500. It's up almost 9% year to date, and 13.5%, close to 14% since election day. There is this policy uncertainty issue. Many of the expectations that push stocks higher immediately after the election and had created some leaders, particularly finance, industrials, materials, and aerospace. We see some shifting of leadership in the market, as you could see in the accompanying table, where I show performance since the election day, since the start of the year, and also since March 1st. March 1st was when we saw the S&P 500 as well as Russell peak earlier. They are at peak levels right now as well. But since the March 1st peak, 6 of the 16 Zacks sectors are still below where they were on March 1st, even though the index as a whole has shifted to an all-time record. A big divergence, as I show in this slide, between the large caps and the small caps. The S&P 500, as we mentioned earlier, is up almost 9%. The Russell 2000 is barely up 2% year to date. So a big divergence between the large caps and the small caps. And the reason, as I mentioned briefly earlier, for the underperformance of the small caps is this question of relatively less robust earnings outlook for the small caps. And a big explanation for that likely is that these are more domestically oriented operators, and they don't really have the level of exposure to the improved international growth picture that the large caps, the S&P 500s have. And that's a big fundamental contributor to the small caps underperformance. But then there is this notion of risk avoidance in the market as well, which kind of ties in with the outperformance of the large caps and then the concentration of the outperformance in either the secular growth stories that we see in technology primarily, or even some of the outright defensive sectors like consumer staples and utilities have been doing reasonably well. So the small caps aren't doing as good as the large caps. The market's leadership is concentrated in a narrow area. And if we don't really see a material shift in the macro backdrop, and by that I mean a significant acceleration in the U.S. economic outlook and some positive indicators of the policy agenda expectations that many were banking on earlier after the election, then I would expect this large cap leadership of the market to continue and small caps to underperform. That's my overall outlook for the market at present.
All right, so let's take a look at the technical perspective of the market. And let me just start off by saying that technically speaking, I think the market looks fantastic. So let's take a look at a chart. So this is a long-term monthly chart. And as you can see, this market has been trading perfectly within this long uptrend channel that dates all the way back to March of 2009. Now, if you were to go all the way out to the right, you can see that by the end of the year, the top of the channel comes in right around 2,600. So a move to 2,600 from where we are today would be about another 6.5% to 7% move from here, which would also put the market up about 16% for the year. So I think that we have a lot of additional gains in store. Now again, this is a longer term perspective. You know, we're only 6 months into the new year, actually the beginning of the 6th month. But I will say, year to date, the market is already up 9%. So I do believe that we are ahead of schedule for where we need to be to reach that 16% year-end target. But anyways, let's take a look at a daily chart now, okay? So when you look at this daily chart, you can see that we have just broken out of a very bullish ascending triangle pattern. And what's interesting is that the top of this ascending triangle pattern was coming in at 2,400. And I don't think that that was any coincidence. That was a very, watched area of resistance, and you can tell by the charts that that it was tracing out the same thing. But clearly we have already shattered through that 2,400. But a lot of people are wondering, well, now what? We've already seen this breakout. What do I do now? I believe the market keeps on going higher, and here is why. When I look at it from a technical perspective, what you want to do is you want to measure the size of the pattern at its widest point. So you want to measure the size of the base, which is what we've already done here. Then you want to add that move to its breakout point, which we've already done on this chart. You can see that this breakout point suggests a move to 2480, and I'm going to just call it 2500. We're going to round it up because the market usually likes big round numbers. So I think the market goes up to 2480 to 2500 within the very near term. So my takeaway would be, if you did see the market pull back from here, I would definitely be a buyer because I think this is telling you where the market wants to go. And if the market keeps on going up, don't wait for some miraculous pullback to take place. I would be buying strength also. Now, once we get to 2,500, we may see some consolidation, kind of like what we did when we were at 2,400. But once we do meaningfully break out through 25, I think we get to 2,600 in earnest, because once again, let's go to this long-term chart. By the way, there's that triangle you see. I believe that this 2600 area, the top of the channel. I believe this is acting as a magnet for the market for this year. So my takeaway is, I think we're going to 2600. I think it's going to be happening quickly. I think we may get there sooner as opposed to later, and we probably are going to break through that 2600 again because, as most people know, I'm expecting the market to double within the next 4.5 years. So 2600 is just one stop on the way to doing that. So I would be a big buyer on the way up, and if you do see any pullbacks, I'd be a big buyer on the way down as well.
Still ahead, Eric Dutram and Tracey Ryniec see if they can agree to disagree. But first, here's a list of recent Zacks Ultimate top movers.
Moody's recently downgraded China's debt, and that has a lot of people freaking out. What's going to happen over in China? Their debt is about 250% of GDP now, and it's still growing. They have that shadow banking issue, which they've always had. So what's the big deal? We're here to discuss the bull and the bear case on China. Should you be investing over there? I'm joined today by Eric Dutram. Eric, you know me, I've been a bear on China for basically 8 years.
The entire time I've known you, basically.
Yes. And I still think a lot of their economic data is fake. I don't listen to any of that. But I recently kind of changed my tune on China.
Which is terrifying.
I know. Maybe I'm a contrarian indicator. I became more bullish, and then Moody's came out with this downgrade, but it hasn't really changed my opinion. And some of that is because I feel like the consumer over in China is recovering. I do think they've been in basically a quiet recession for the last couple of years. But when I look at the statistics from some of these consumer-based companies, the ones we can get real data from, so I'm talking about like the Western-style businesses. So Yum China reports from over there, they're the biggest restaurant chain, and it was good. Like the KFC, which has always been their big brand, up 1% for same-store sales this last quarter. Even Pizza Hut, that's always been kind of their lackluster one. That was up 2%, so that gave me a little pause. And then I looked at the Starbucks numbers. They're not as big as KFC over there, but they're quite considerable size now.
Sure, but I mean...
And it's good over there, too, with them.
Sure,
so,
but at the same time, China still had a lot of problems rebalancing its economy to get more consumer-centric. A lot of it is still industrial-focused, and we've seen iron ore prices go down by about 30% in the last 3 months. And since China has more than half of the world's iron ore demand, I don't know, it's not really a good sign. And I think with all the debt issues, it's going to be a harder time for a lot of these companies to get more capital. So it's going to be less industrial production. So yeah, maybe some things are looking better on certain individual stocks, and there's a little bit more consumer focus. But I don't think that changes the overall China picture, especially if we look at the overall number of people in China. The working age population is actually on the decline. So they're going to experience a lot of issues that a lot of the developed market countries are facing in terms of having too many older people and not enough younger people to balance it out. That's why I think a country like India that has a much better demographic profile is going to be a much better choice for investors.
So you don't think they can still gut it out, and that these reforms that they're doing, which have been pretty substantial, you know, they keep putting things on for the housing market so that that bubble is kind of maintained and under control, and they've been spurring some other businesses other than these big industrial giants to try to spur, you know, as we said, the consumer side. You don't think they're going to be able to keep it together? Because for some reason, I kind of do think they're going to keep it together now.
Yeah, I mean, I think they can keep it together for a while, but I think eventually something has to give in the Chinese market. And so much of the growth has been focused on people going from the countryside over to the cities on the East Coast. At some point, they're going to get more growth back in the, you know, the interior region of the country. And they really haven't done a great job of that so far. So I think that's still a long-term concern they haven't really figured out any solution for.
So you don't think China could be the key for the global economy of, a kind of a rebound there, pushes up everybody else?
No,
Is that off the table now?
I think their best days are behind them in terms of growth, and I think people need to look to India and other markets, maybe even in Indonesia that has a better growth profile. I think China's had its day in the sun, and hey, we got to move on.
Okay, I'm kind of on the other side. I did notice that this was Moody's first downgrade of the country since 1989, since the Tiananmen Square. So it's kind of a big deal.
Yeah.
But it's not making me that nervous to buy these consumer names. Maybe that's the key, is to stay in these kind of big consumer names like the Yum Chinas and maybe even like the Baidus, some of their tech side.
Yeah, that's a good point. The tech sector's been doing really well in China, and that could be more of a growth area as opposed to, like the banks or the oil companies. It might be more difficult in those type of firms in the near future.
Yeah, I can't believe I am still bullish.
Yeah, that alone, you being bullish on China is enough, I think, to be bearish on it, given how negative you've been on the country for so long.
I know. I do have to say, some of the commodities situation which you just talked about does worry me, because that's their big bread and butter, and it did look like in 2016 that was improving. We no longer had those ghost ships sitting offshore. Remember that from a couple of years ago? That kind of went away, but it has kind of turned scary again in 2017. It seems like they can't get any momentum on their big industrial side.
Right.
And so I'm a little dubious, but I'm holding on hope for that consumer over there.
That's enough. That and the tech will be enough.
I'm hoping, yeah. So I am more bullish than I ever have been. So we'll see.
Yeah.
We'll see maybe towards the end of the year how things shake out, and we'll have this discussion again.
Definitely.
All right. So Eric and I might be back later on. Be sure to tune in, and maybe we'll be on other sides. Maybe you'll be the bull.
That's right.
Time. So we'll be back later this year.
Next up, Righty's Mailbag. Here now, though, this list of recent Zacks Ultimate new additions.
Hey everybody, welcome to Righty's Mailbag for the June edition of the Zacks Ultimate Strategy Session. Got 3 additional questions today to broaden our understanding and usage of the Zacks rank, so let's see what we got. The first question comes in from Mike J, and he wants to know, when we're comparing the Zacks rank versus the style scores, which should have preference consideration of what to buy and sell. We get this one all the time, and yeah, it would be easier if we just had one rating, but we're trying to enhance everyone's odds of success. So having multiple rating systems and layering them one on top of the other increases your likelihood of being in the market. So in real estate, they say that location, location, location is what matters for your property. When it comes to stock investing, it's the Zacks rank, Zacks rank, Zacks rank. So that is our first and foremost consideration. And then we take a look at the style scores, then we take a look at the industry rank and things of that nature. So just to make this abundantly clear, the Zacks rank is computed every night. The computers are taking a look at the newest earnings estimates. We come up with the new Zacks rank. About 5% of the stocks, 220 stocks will be ranked as #1 ranked. Then and only then will we take a look at the style scores. And then we put 20% in the A category, 20% in the B, and so on. Meaning the style scores are absolutely a secondary consideration after the Zacks rank. So start with the Zacks rank, then take a look at the style scores and industry rank and things of that nature to put the odds in your favor. Okay, what do we have here for our next question? John O writes in, are Zacks #1 ratings future or trailing indicators? Now, the quick answer is it is a future indicator. We're trying to give you a rating that helps you be successful in the future, not in the past. We're not going to the time machine. But where does this question come from? I totally understand it. Because one of the most popular rating systems on the planet is the Morningstar Mutual Fund rating. And that is based upon past performance. And as you've heard time and time again in commercials, past performance is not a guarantee of future results. It may make us feel a little more comfortable, but it's not the greatest indicator of what's going ahead. So the Zacks rank is absolutely future looking. Now, I could say that till I'm blue in the face, but it's better to show you some more specifics as to why that is. So when we take a look at the Zacks rank return, the Zacks #1 ranks at 25%. That's 2.5 times better than the S&P 500. Now here again, how do we calculate this? Well, the stock has to become a #1 rank first, and then we can measure its performance. So absolutely, it is after the fact, future looking, that we are judging the value of the Zacks rank, and clearly it helps pay the bills. All right, let's move on to that third question, because this is a little bit of a meatier subject, and is how to use the Zacks rank for long-term investing. So yes, we talk quite often in our materials, the Zacks rank is a little more of a trading mechanism. It has a 1 to 3 month time horizon. And there are tens of thousands of investors who use it every day to help select the best and most timely stocks. Yet there are still legions of people, including myself, who use it on a long-term basis. And so it absolutely can be done that way. What we have to do here is we just have to relax some of the standards that we use when we are trading, which is to buy #1s and then sell if it falls to a 3, because we want as much of that earnings estimate revisions power in there. So how does a long-term investor apply it? So come up with this table here. We're going to buy #1 and #2 ranked stocks. Obviously, #1s are better, but there's still some attractive ones in the #2 camp, especially if you're looking at larger cap stocks. It's hard for them sometimes to make #1 ratings, so a #2 large cap is not such a bad thing. So we're buying when that's the case because earnings estimates are coming up. There's something that says about its earnings momentum and about what's going on in the company. The things are looking better in the future. So we're buying that because it does have prospects of continuing that quarter after quarter. Now, we hold when it gets to a 3. Okay, even though the rating's called hold, but too often what we've learned from the brokerage industry is that they don't say sell, and so when they say hold, we think they mean sell. We mean hold when we say hold, okay? Because that stock will be about in line with the market. But typically, when our #1 and #2 ranks become a hold, it's not because the estimates went down, it's because the timeliness element of the Zacks rank, the 60-day time frame that we're taking a look at estimates, there's no fresh estimates. So it falls back to a state of neutral. And so what we want to see here is what happens on that next earnings report. Do they beat? Do they raise? Do estimates go higher? And hopefully it comes back up to a #1 or #2, and that is why we keep riding out those stocks in the future. But if it has a failure, if estimates go down and becomes a #4, #5 rank, we're absolutely going to sell. This is not buy and forget. This is buy and watch carefully to make sure we have a stock that has the right ingredients to outperform in the future. So let's pull this into practice. What I pulled up here is the chart for Chipotle. This was a lot of people's, one of their favorite long-term holdings. And as you can see here, looking back in time, it's come up a great deal. And that's year-over-year earnings. So the colored bars are the earnings estimates. The black line is the price. Price going up, its earnings are going up, and everything's wonderful with the world. And here we are a few years later, and it's peaking at about $750. As we all know what happens right in here, okay? They had a food scare. The health of their food was being questioned, and yes, less people came. So this is not a case of selling exactly at the top. This is about, if we really take a look at where the estimates start to come down, we could have gotten out about $650, $600, somewhere in there, which is plenty to capture all that profit. But look at what happens if you don't heed that signal. If you say, oh, but I love Chipotle, and they'll come back around. When things go bad, there's that earnings estimates going down because it continues to get bad. It is an absolute avalanche in estimates. It's an absolute avalanche in the stock price. So this is buy and watch carefully, not buy and forget. And so as the estimates are looking good, we stay in. When the estimates start to tumble, we are out. And we lock in our profit and we move on to the next stock. So that's Righty's Mailbag for this time. Look forward to your questions that come in for the next go around, and always looking forward to sharing great investment success with you.
Sheraz and Kevin will conduct a portfolio makeover right after these interesting insights from Zacks Ultimate Editors.
In this month's Portfolio Makeover, we're going to be going over some of the most common mistakes that people make when they are creating their portfolio. But I do want to say we are not going to be giving any personal advice or, focusing on any kind of specific action to take on any stock. What we're really trying to do is we want to take a look at what people are doing right in their portfolio, what people are doing wrong in their portfolio, and provide some helpful tips so you can create a more successful portfolio and greater profitability. So the one we're going to be looking at today comes from Charlie. He is a Zacks Ultimate member. So Sheraz, what do you see first?
Thanks, Kevin. I put Charlie's portfolio in the Zacks portfolio tracker, which I strongly recommend to all folks to do. A very handy tool. And there's plenty of stuff that we could discuss about Charlie's portfolio, but what stands out to me up front is the number of holdings in this portfolio. Yeah. As you could see here, we have it on the screen. We have only 7 holdings, of which one is an ETF, so you have a total of only 6 stocks. Now, there's a lot of debate about what is the optimal size of a portfolio. It's a function of the dollar size of the portfolio as well. But to get the optimal benefits of diversification by lowering your risk profile and increasing your odds of not losing out on any winners, they typically say that 15 to 20 is a good minimum to shoot for. Yeah. We obviously have 16 sectors in the Zacks database. The official Standard & Poor's has 11. Right. So if you restrict yourself to 6 or 7 stocks, you obviously cannot have the diversification. Now, if you have 6 or 7 ETFs, perhaps you could have the full diversification. Sure. But the number of stocks or the number of holdings here is the most notable thing that stands out to me, and I don't think it's enough what Charlie has right now.
Yeah, I agree. The 7 stocks, that is just not enough. I mean, at the very minimum, I think you should have at least twice as many. Sure. But my biggest problem with Charlie's portfolio right now is that it is dominated by 2 specific categories. It is China and tech. So if you were to look at this first stock, that is Alibaba, that is China and tech. Granted, that is kind of like a marketplace. It's like Amazon, the Amazon of China, but I still kind of consider that to be tech, okay? Then you also have YY Incorporated, that is China and tech. They're like the Facebook of China. Sure. Then you've got Yum China. Obviously, that's not tech. That is China, though. So you've already got 3 China plays so far. Then when you look at the rest of the portfolio, you've got Micron Technologies. That is tech and semiconductors, to be specific. But what's interesting about Micron is that they get the bulk of their revenue from China. Then you've got NVIDIA, more tech, semiconductors in particular. Then you have XLK, which is a tech ETF. Again, more and more tech. And then lastly, you have Snapchat, which also is tech. And by the way, that is a company that I absolutely hate. Now, Charlie did say when he made his submission, he wanted to know if he should sell Snapchat because I believe he is down 25% from where he got in. I can't tell you what to do, but again, I am not a fan of Snapchat. For me, if they can figure out how to monetize a bunch of 10-year-old kids, that would be fantastic, and then I'll probably jump into it. But until that time, I am getting nowhere near it. But you're going to have to figure that one out for yourself, Charlie. But I will say, if you look at Snap, you can see they are a Zacks rank of a number 3. Take a look at the screen. You can see their style scores are D's and F's across the board, and they have a VGM score of F. So I'm not a big fan of Snapchat. But anyways, let me just say a few more things. I'm not bashing China or tech because China and tech have been doing phenomenal this year. The Hang Seng Index is up 18% year to date. Tech is up almost 20% year to date. So, you know, you're doing excellent there, but you need to realize China and tech are not always going to be the leaders. One of these days, they are going to be the laggards, and when they become the laggards, it is going to crush your portfolio. So I would say at the very minimum, you should be diversified over at least 5 different sectors.
Sure.
Within those sectors, you should identify several different industries, and from those industries, you pick up another couple of stocks. So that is what I think you do at the beginning. Shiraz?
I think we have been a bit too critical of Charlie here.
Well, Charlie's doing great right now, so we're not bashing him.
These stocks are very good.
Yes.
If you look at the portfolio in our tracker, there's plenty of green.
Sure.
Which on a day which is modestly down shows that it's a healthy portfolio. Yes, the size of the portfolio, the number of picks, I mean, and the lack of diversification are issues. But you see, it's Zacks rank 1, 2, and 3.
Sure.
The average Zacks rank for the portfolio, 2.5, is very good. If you look at the industry ranks, we have about 260 or so industries.
Right.
We typically tell folks that the top half of the industries outperform the bottom half by a factor of 2 to 1.
Correct.
So most of his industries, even though this is all tech, but the tech sub-industries he has are in the top half.
Right.
So on the whole, his picks are very good, and they have plenty of growth potential. And I'm sure, depending on when he picked each of these stocks, he has done pretty good.
Right.
Yeah.
I'm assuming that because Charlie is so heavily concentrated, I'm guessing this wasn't accidental. I'm assuming that this was totally on purpose. So kudos to you for picking such good stocks, except for Snapchat. But yes, be very cognizant about when this thing is going to turn around, because again, when this goes down, you do not want to be left holding that bag. The other thing I would say, though, if you're trying to incorporate more diversification, I like doing a little bit of top-down analysis. And when I do top-down analysis, one of the things that has worked very well for me is to look at the employment situation report. The reason why I like looking at that is because I like to look at the sectors that have created the most amount of new jobs. Usually you're looking at robust hiring because there is enough sales activity to warrant it. Increased sales equals increased earnings equals increased stock prices. So that has been a really good thing for me. Now, we just had an employment report out on Friday. So check this out. The 5 sectors that created the greatest amount of new jobs in the latest month was professional and business services. They were up 38,000 new jobs last month. Healthcare, that was the second largest sector of job creation. They created 24,000 new jobs. Actually, they're up 224,000 over the last 12 months.
That's right.
Food services and drinking places, which is government speak for restaurants and bars, they were up 30,000 new jobs last month and 267,000 for the last 12. Then you've got construction up 11,000. Finance also added another 11,000 new jobs. So these are good places to start. And again, using the jobs report has been a very good thing for me. Consider using some kind of top-down analysis when you are trying to create more diversification.
Sure.
Anyways, I hope this portfolio makeover segment was helpful. If you find yourself with too few stocks or overly congested in one of these areas, I hope these tips have helped you out.
Top stock picks are still ahead, but here are a few things you can expect to see coming up. Make sure to check out the 7 best stocks for the next 30 days weekly report, where Zacks experts reveal 7 stocks handpicked for immediate profit potential. Plus, keep an eye out for the Ultimate 4 report, which includes 4 stocks our team believes have the greatest upside potential over the upcoming quarter. This latest report features the favorite stocks of David Bartosiak, Brian Boland, Tracey Ryniec, and Brian Hamilton. It'll be posted on the Zacks Ultimate homepage in July. And don't forget the next Zacks Ultimate Strategy session will be posted around mid-July, so start thinking of those submissions for Righty's Mailbag and the Portfolio Makeover segments.
My top stock pick this month is Nutrisystem, ticker NTRI. You know this company. They have Marie Osmond as their spokesperson, but they're also targeting men. They have those great ads that they're running about how the men's pants don't fit, but the diet and wellness area is really hot right now, and so is Nutrisystem. In the first quarter, they beat and they raised guidance, both on earnings and on sales. Sales expected to rise 20% this year, and earnings about 37%. That's really hot. And their Zacks #1 rank. The estimates obviously are rising after that beat and the raise, so I like that. Now, it's not a value stock. I know, I'm the value stock strategist, so what am I doing bringing growth? But I like growth too. And this is an area that is really growing on all categories. The food delivery service, which is what Nutrisystem specializes in, is just doing great right now. Their shakes are popular, as well as the a la carte menu items. So if you're looking for a consumer-based company that's not in retail, but is still right on trend, Nutrisystem is the one for you. Again, the ticker is NTRI.
Hi, this is Sheraz Milan, and my top stock is Caterpillar, a truly global player that needs no introduction. Only about 45% of its revenue comes from North America, so a lot of global exposure. And the reason I'm picking Caterpillar is that all of its core businesses, construction, the global infrastructure, as well as the mining, the outlook for all of them has started improving notably. The stock has been doing relatively good lately. It's up 14.4% year to date and is at 52-week high right now. But despite this strong recent performance, it's practically below where it was in 2011. So still plenty of upside in the company. The earnings outlook for the company has improved quite a lot. They had an impressive Q1 where they beat estimates, guided higher, and showed impressive momentum in their backlog. As you could see in this price to forward 12-month EPS estimates chart, there's a very strong turnaround that we saw in the estimate revisions front post Q1 results, and that's the reason that pushed the stock into a Zacks rank #1. All in all, Caterpillar is a solid player in any long-term portfolio, and the company's balance sheet is in excellent shape. They pay a very attractive dividend as well. Strong leverage to the global economy, the uncertain outlook for the U.S. infrastructure spending, the so-called Trump trade, is an issue for Caterpillar, but I strongly feel that the improving outlook for the global economy, particularly the bottoming of the commodity cycle, and the synchronized growth that I referred to in the fundamental overview segment, those all bode well for Caterpillar. I strongly recommend Caterpillar for all long-term investors.
Well, that's another Zacks Ultimate Strategy session. We hope you enjoyed it and you found it informative. And if you have any feedback, don't hesitate to send it to mailbag@zacks.com. Meantime, if you have any questions about the Zacks Ultimate service, don't forget you can always contact your account manager at ultimate@zacks.com or by calling 888-775-8348. International callers should use 312-265-9309. Until next time, thanks for watching. We look forward to sharing success with you, as we always tell you, for many years to come.